JP Morgan, Raoul Pal, and a ton of other investors are now starting to talk about the debasement trade, how cryptocurrencies like XRP are used. Let's go through this strategy and what it's going to mean for you. I have a ton of clips and information you have to see. Imagine waking up to find your dollars are buying less and less while gold, crypto, and other hard assets are hitting all-time highs. That's not a random fluke. It's the debasement trade, a tidal wave of money fleeing fiat currencies as governments crank up the printing press and debt explodes.
Even JP Morgan talked about the debasement trade. I mean, we've been talking about it in crypto for fucking 10 years. And finally, they've like, oh, they're debasing currency. I'm like, finally.
And I got an email from Goldman today, the debasement trade. How do you play the debasement trade? I'm like, I've been talking about it for 12 years. And so, yes, we were there early, but let them get the glory. You know, they're all talking about it.
Let's explore what the debasement trade is and how you can participate using this strategy. So the debasement trade refers to a market strategy where investors shift their capital into assets expected to hold or increase in value as fiat currencies lose purchasing power due to the explosionary of monetary policy, high government deficits, and inflation. In recent years, this theme has gained traction because of its persistent concerns about debt, stimulus spending, and central banks printing money, which can erode the real value of traditional currencies. The debasement trade is fundamentally a defensive move against currency debasement, which occurs when an increase in money supply is growing and sovereign debt weakens the buying power of a currency. This is historically driven by investors to seek refuge into hard assets, things of intrinsic, non-dilutable value or limited supply. Examples would be gold, silver, Bitcoin, XRP, those type of things. Let me run through this with you.
Some of what's happening is basically things that those of us in either the Bitcoin space or the gold space have been talking about for years are kind of hitting the mainstream. So I think it is absolutely true that from a structural perspective, trust in the major fiat currencies is increasingly diminishing. The only thing that can stop the train is a major default on existing obligations. Yeah, likely not nominally, likely through purchasing power. So major devaluation compared to gold and other hard assets of the currency, combined with then some sort of reform to stop the existing bleeding. The reason gold is so valued is that central banks can hold it in their own vault, in their own jurisdiction, and there's no one that can really kind of just rug pull them. There's no one that can change the rules other than an outright invasion or something. For the first time, I had a friend in Egypt ask me if he should get out of the dollar because he's concerned about the dollar, ironically.
I think that a lot of people are very concerned. Participating in the debasement trade means positioning yourself to benefit as fiat currencies lose power due to excessive monetary creation, rising debt, and negative real yields. Investors do this in rotating capital out of fiat into sovereign debt. So this is what we are seeing in real time. How to participate here if you're interested in knowing the steps. And I got a great clip here by Anthony Popoliano getting into this even deeper. But just so you understand here, move out of debasing assets, reduce exposure to fiat denominated bonds or low yield cash instruments that erode in real terms. Investors are exiting US treasuries and reallocating stores of value as deficits increase and as yields fail to beat inflation. Accumulate scarce digital assets, build position in assets with limited supply. Examples would be Bitcoin, still viewed as digital gold due to its 21 million cap supply. XRP offers a hybrid scarcity model. Ripple relocks escrowed XRP, efficiently tightening circulation while preserving transaction function. We've also seen XRP available on exchanges slowly decreasing over the last 12 months. I do think as ETFs and other products are approved here in the next few weeks to few months, this could totally deplete the available XRP on exchanges, sending the price through the roof. Ethereum, of course, we know this as one of the most and vital important parts of the crypto space here. Benefits from EIP 1559 tokens burns, making it deflationary. Ethereum also has an unlimited supply. This phase involves dollar cost averaging into these positions, reallocating a share of one's portfolio to a hard money crypto basket. Use on-chain yield or treasury integrations. Engage in yield generating protocols that preserve scarcity. XRP's Project Firelight via FXRP staking allows holders to earn yield without inflating supply while maintaining functionality for cross-border settlements. Similar opportunities exist through token staking and lending platforms. You also have pair crypto positions with stablecoin liquidity. Stablecoins like USDC and USDT serve as a flexible liquidity tools. They enable investors to exit fiat systems while remaining in tokenized dollars, facilitating rapid trades between hard assets. Holding some stablecoin exposure supports tactical rebalancing during volatility. You can also track institutional ETF flows and integrate multi-asset hard money exposure. Let me go ahead and show you some other times in history when we've seen things like this happen. The debasement trade is a far about a narrative than reality. Why? Assuming increase in money supply is how you define debasement. The dollar was debased more from 1980 to 85, 1960 to 65, and 1880 to 85, and about the same from 2000 to 2005, 2010 to 2015. And it was from 2020 to 2025. So looks like this has played out in the past very many times. We've seen this play out a whole bunch. And here's Anthony Popoliano with a lot of really good information about this subject.
Ladies and gentlemen, it seems that the debasement trade is the talk of financial markets. So I wanted to learn more about it. And I asked one of the brightest minds I know to put together an overview of what is really truly happening right now. Now, this person wishes to remain anonymous, and I respect that. And you can follow them on X at the account that's linked below. But here's what they told me about the architecture of debasement, the anatomy of the fiat illusion. First up is our core diagnosis, the death of the measuring stick. Something extraordinary is happening beneath the surface of global markets. Gold and Bitcoin, it's two assets that have long been treated as opposites. They're rising together. On the surface, it looks like a bull market and everyone's excited. But in reality, it is a failure of measurement. In USD terms, US assets look euphoric. The Nasdaq's up 165%. The S&P's up 102, and home prices are up 56% since COVID. But when you redenominate in gold those gains, they shrink to flat. In Bitcoin, they implode. Nasdaq's down 78, S&P's down 84, home prices are down 87. What appears as growth is simply the mirror image of a collapsing unit of account. Now, this is the same pattern that appears at the end of every major currency regime. People feel richer in the debasing unit because the unit is melting faster than the asset can rise. In real collateral terms, they're already poorer though. Gold and Bitcoin aren't going up. They're marking down the old world in real time. This brings us to the internal mechanics. Debasement doesn't begin with printing presses. It begins with the arithmetic of empire. The US system depends on three key linked pillars. The first, structural deficits. The government today is running peacetime fiscal gaps of 6 to 8% of GDP. That is unheard of outside of wartime. The second is debt saturation. Federal debt has crossed 120% of GDP. Corporate and household debt are also at record highs. Negative real yields is the third thing. The only way to finance that load is to keep interest rates below inflation, which silently transfers purchasing power from savers to the state. This is why wages lag prices, why policy feels reactive, and why wealth feels hollow even in a booming market. We're in a world where the money supply has outrun the narrative explaining it. That's a big deal. The Fed is still using 20th century instruments to manage a 21st century reflexive spiral. The US is executing the last phase of an imperial carry trade.
This is the reason why we need new systems to track information in real time. You take a look at what Polymarket could do and how the government collects information. You see that these two systems are much different, and you start to wonder how blockchain infrastructure can help speed along the gatherment of this information so we can make better decisions in real time that will affect positively on the outcome of the people in any country those decisions are being made.
They attract global capital, they inflate nominal asset prices, and they export the currency risk to anyone still holding dollar claims. It worked for Britain in the 1920s, and it also worked for America in the 2010s. But no empire in history survives once its own citizens begin thinking in alternative units. And that's where we are right now. For the first time, a critical mass of investors are measuring the world in Bitcoin and gold instead of dollars. Once that shift hardens, the regime is already over. Once real yields go negative long enough, three things happen now. The first is nominal asset prices will rise mechanically because future cash flows are discounted at a lower real rate. This is the wealth that people see. The second is that hard collateral stops circulating. Gold's going to pile up into central bank vaults, and Bitcoin will move off exchanges. And third, alternative units of account emerge. Investors start benchmarking their portfolios to something other than the official currency. And this is happening in real time right now. Central banks have been net buyers of gold for 27 consecutive months. The dollar's share of global reserves, that's at a 30-year low. And treasury auctions are increasingly reliant on indirect bidders rolling shorter maturities. These are all classic pre-revaluation signals. It's the same behaviors you see before a peg breaks in a currency. The mechanical fuse is duration mismatch. Every sovereign, every corporate, and every household balance sheet, they are all now levered to a low-rate debt that was issued in a high-rate world. Refinancing risk has become reflexive risk. Every basis point higher forces more issuance, which forces more monetization. That's why you see this version of debasement being terminal. It's the arithmetic endpoint of a 40 years of compounding leverage. The system can't normalize without collapsing its own collateral. So this brings us now to the historical signature. Rome debased its coinage 90% before the Western Empire collapsed. The French monarchy printed assignats until bread cost millions of livres. Weimar Germany ran negative real rates and massive deficits before the mark imploded. And the British pound, it didn't lose its reserve status in 1944, but instead in 1925 when the Bank of England tried to return gold to an overvalued rate, and all of a sudden foreign creditors stopped believing. The pattern is always the same. The empire's liabilities exceed its productive base. It finances the gap with monetary alchemy. Nominal asset prices look strong, but then measured in real collateral, they stagnate or fall. Eventually, the public abandons the old unit of account and they start thinking in the next unit of account. That's exactly where we are right now.
That is where we are right now, ladies and gentlemen. Listen, if you guys like this content, please hit like, let me know down below. I will play out the rest of the clip for the people that want to finish. Just want to thank you so much for all the support we're doing. I just can't. It's incredible. I love you guys. You guys are awesome. That's all I got.
In USD terms, US assets look fine. In gold, they're flat. But in Bitcoin, they've already collapsed. That's the scoreboard of a dying denominator. This brings us to the reflexivity phase. Every debasement cycle begins as an accounting error, and it ends as a reflexive panic. In the early 1920s, Weimar officials thought they were stimulating demand. They were actually erasing trust in the mark, though. In the 1970s, US policymakers, they thought that they were managing employment, but they were detonating global faith in the dollar. Once a population starts shifting its internal unit of account, the collapse becomes self-reinforcing. Policies meant to stabilize, things like rate cuts into inflation, QE under negative real yields, fiscal transfers funded by issuance, those things signal only one thing: the money itself is melting. Wall Street still calls Bitcoin a risk asset, and they do that to preserve a narrative frame. But functionally, it already acts as a parallel reserve ledger. It's the only denominator in the world that exposes the post-2020 economy as what it is: a slow-moving Argentina. Gold is the system's ancestral memory, 5 millennia of default insurance. Bitcoin, that's its emerging consciousness, the ability to step outside the denominator entirely. One remembers value, the other redefines it, and reflexivity is the hinge. Once belief breaks, measurement becomes the accelerant. Capital stops seeking yield and it starts seeking refuge. Gold absorbs the instinct to remember, Bitcoin absorbs the instinct to evolve. And so in closing, fiat is the entropy of truth, the point where symbols detach from substance. When the gap grows too wide, the system's own feedback loop, markets, nature, and collective intuition, they all trigger a restoration cycle. And that's what this moment is. Gold and Bitcoin rising together is the world beginning to price truth again. It's the deep field of reality pulling the ledger back into alignment with the physical laws of energy, scarcity, and time. We are witnessing the recollapse of abstraction, the return of the real. Nominal charts will keep rising. Real value will keep falling. And until the illusion is complete, and then suddenly the mirror, it will flip. Gold and Bitcoin won't have gone up. They will have simply stayed real long enough for the world to remember what that truly means.
This is basically the dollar not being the world reserve currency anymore and losing extreme value along with other currencies. This is why people are hand over fist trying to get into digital assets, because they think that gold, silver, and digital assets will remain valuable as these fiat currencies melt. All right, guys, I know this is a different video than we normally do. I don't know if you guys enjoyed it. You're gonna have to let me know down in the description. I am kind of sick right now. I do apologize, but I wanted to make this video. Thank you so much.